House prices to crash by 73%. Here's a chart, PCE excluding food and energy at the highest growth in decades. As Zoltan Pozar said, the Fed has to crash the markets to fight inflation. There's really no way out. Inflation keeps increasing, and this soft landing is just a myth. And in breaking news, the German central bank is worried about banks lending to overextended buyers in an overheated property market and reserves the right to impose additional curbs. History might not repeat, but it rhymes. And markets are pricing in a 2.8% RBA cash rate in 12 months. And from my buddy Tarek, as speculation over rising rates in the US and Australia continues to build, markets continue to price in huge rate hike cycles. Hikes by year's end in the US are 10 and Australia 8. The uncomfortable question for many is, what if it takes this level of hikes or more to tame inflation? And from Tony Nash, mortgage broker, telling me last night he's processing home loans at 5.99%, previously 3%. Soon he'll see 8%. Now, here in Australia, we own a mortgage broking business right across the east coast of Australia. And we've been seeing banks, even in towards the end of last week, hiking rates, their fixed rates in particular. We're now looking at around 5% on the 4 and 5 year fixed rates. And Bullard says even a generous reading of monetary policy rules show federal funds rate of around 3.5% needed to fight high inflation versus current rate of 0.25% to 0.5%. Well, if they think that 3.5% is going to do it, they're kidding themselves. If they're going to fight inflation, they're going to have to raise rates a lot higher than that. And here from CNBC, rising mortgage rates are causing more home sellers to lower their asking price, Peter says, and so it starts. And Goldman Sachs here warns that the Fed may hike to above 4%. So their base case is by the middle of next year that the Fed will raise rates to a little over 3%. But if the economy doesn't slow down, then they do see the Fed raising rates above 4%. So we have David Stockman, who was Reagan's former budget director, warning about a coming stock market crash of biblical proportions. And he's talking about a 70-80% fall because he's saying that the Fed are going to have to raise interest rates between the 4 and 6% level to fight inflation, or CPI. And David is adamant that the Fed are going to do it. That the Fed put is much lower than the market expects. He thinks that the S&P 500, the Fed put is around 2,000. That it's much lower than what the markets expect, and that the Fed aren't going to do a power pivot this time, and they're going to allow people with financial assets to get hurt. And this chart is one reason why they're saying that the Fed and central banks this time won't do a power pivot. So this is world food prices now hitting all-time record highs. And love my artistic skills there with my red shape. That is what caused the Arab Spring. And we're seeing in Peru, even in China, I'm hearing talk from Germany. There's food shortages, especially around flour and oil. There's rationing happening. So if any of my German friends can confirm that, I've got some German friends here in Australia, and that's what they're telling me. And we're seeing other areas now starting to, social unrest. with food prices and inflation, and it becomes a political issue. And so governments are now putting pressure on central banks to raise interest rates. And I found this very interesting, that the US 10-year has finally broken out of this downward channel. And the Australian 10-year, today, day of this recording, which is Monday the 11th of April, the Australian 10-year is above 3%. So you can see from this chart the debt trap that Australians are in, with household debt to disposable income pushing towards 200%. So a lot of people will argue that housing affordability is better than it was back prior to 2006. But 2006, that was prior to the GFC, when we had much, much higher interest rates. We had clients locking in fixed rates at 8% back then. Over 8%, 8.5%. But they look at the mortgage repayments as a percentage of disposable income. Now, if the cash rate goes back to 2.5%, then we're all of a sudden back to record high in terms of percentage of disposable income, mortgage repayments as a percentage of disposable income. But the interest cost is back down to its levels of the late 90s, when mortgages were a tenth of the size than they are now. Okay, I'm exaggerating a little bit. But you can see the middle line, that the principal, that debt has actually increased. And this chart's actually a little bit old. This chart actually shows it a little bit better. This goes back to December last year. So household debt to disposable income. And it's similar to that green line that we just looked at. So you can see that now household debt to disposable income, that's a total debt, has now risen back up to all-time highs. And it was at that level before the you know what. And so that principal portion in that green line is higher now. And as the cash rate goes up, and if we're looking at the Fed raising rates to 4%, that Goldman Sachs say they might, David Stockman says that they're definitely going into that 4 to 6% mark, and mortgage rates are going to be extremely high. And with record high debt levels, and now this is Australia I'm talking about, but even here, the market is predicting that the RBA is going to be raising rates to close to 3.5% by the end of next year. So that means we're talking about mortgage interest rates, variable interest rates at over 6%. Now, we haven't seen them for a long time. And with people's debt levels that they've got right now, this is going to get very, very interesting. Aussie house prices to crash 73% on 14 straight interest rate hikes, according to Macro Business. It's a laugh a minute now for house price bears. Interest rate markets now pricing nearly 14 straight interest rate hikes from the RBA by mid-2023. The recent bottom for the fixed interest rate mortgage boom, which comprised 90% plus of new issuance, was around 2%. If markets are right, these will be rolling off at an astonishing 7% flexible rate across 2023 and beyond. And yeah, in our business, over the last 2 years, we've had clients lock in, 3 and 4 year fixed rates at 1.89, 1.99%. And they're going to roll off in the coming year, next 2 years. And they're going to be paying something like, well, according to this, 7%. So they're going from under 2% to around 7% mortgage rates. And here are the income impacts of this on Aussie households. So you can see the median monthly mortgage repayments for Sydney, Melbourne, and the national in green, and then the market forecast, and that's with a 3.5% rate rise. Also assuming a 30-year loan term, 20% deposit and P&I loan. Well, you can see that that is a lot of mortgage repayments coming out of people's disposable income. Not to forget the increase in inflation and the increase in CPI, that the cost of living, that's also eating into people's disposable income, and wages are not rising to keep up with this. And so there are big risks ahead. And this chart, Australian debt repayments to household income. That is a very, don't forget, people, mortgage debt has increased over the last 2 years like I've never seen it before. And I've been in the lending game for almost 2 decades. And so we're seeing much larger mortgages. But now we're going to see higher interest rates. Here's what the RBA says about interest rate sensitivity and house prices. At a user cost of 6%, we estimate that a sustained percentage point drop in interest rates would, in the long run, boost housing prices by 17%. Holding rents and other components of the user cost equal. This semi-elasticity, the proportionate increase in housing prices for a given percentage point increase in interest rates, is larger than the time series estimates of Appleson 2005, perhaps because they control for many other variables affected by interest rates, example, share prices and income, so only capture part of the effect of interest rates. Our estimate is similar to Gittleman and Otto's 2012, page 183, estimate of 20% for Sydney housing prices using disaggregated census data, and Himmelberg, Mayer and Sinai's 2005, page 78, estimated range of 19 to 33% for the United States in a calibrated model. A user cost or rental yield of 6% is the approximate average over Gittleman and Otto's sample. User cost models such as equation 4 imply that the semi-elasticity increases as the user cost declines. Effects on prices become extremely large as the denominator in equation 4 approaches zero, with a current user cost of 3.5%, well below that observed in the studies above. A percentage point drop in the expected real mortgage rate would boost housing prices by 28% in the long run. In short, at low interest rates, house prices volatility is dramatically amplified. Based on the RBA's own model and a little poetic license, house prices will fall 28% for every 1% hike. This will not happen all at once, so let's give it 3 years to fully play out. After 1 year, a fall of 28%. After 2 years, a fall of 48%. And after 3 years, 73%. Obviously, this exercise is more than a little bit rubbery, but it makes a solid, if a theatrical point in the broader sense. The RBA smokes the same mull of PCP, ketamine and crack that interest rate markets do, then by mid-2023, the Australian economy will be lying dead in the gutter. And this is from David Llewellyn-Smith, who's the chief strategist at the Macro Business Fund and Macro Business Super. So in recent weeks, months, I've done a few videos, Billionaire's Recession Depression Warning, where in this video I talked about the impacts on stocks, bonds, and real estate. Also did this video, market crash and economic collapse. Once again, just warning about interest rate rise and what it means for, once again, bonds, stocks, and housing, and actually how that gold and silver and wealth cycles could buy you a lot more house, buy you a lot more stocks in the near future. And I also went into a deep dive in this video, housing bubble to burst. So do I think housing is going to fall 73%? I don't think so. Do I think housing is going to fall? Absolutely. I think we've been in a crack-up boom built on credit. You have a look at a chart. Look at these videos. I'll put links in the description below to these videos if you haven't watched it. I share charts in these videos about the amount of mortgage debt growth that we've had in the last 2 years. And so it's not surprising to see house prices go up the way they have. But it's a crack-up boom. And what happened in the crack-up boom in the late 1920s? Ludwig von Mises warned that we're about to see a massive stock market crash, and everyone laughed at him. Everyone laughed at him. And what happened? So Austrian economists are warning the same thing. As an Austrian economic analyst, I'm warning people that own housing. If you have bought an investment property for capital gain, you're negatively gearing it, so it's costing you dollars in holding costs, and you've bought it thinking that over the next 2 to 3 years, 4 years, you're going to make a killing out of property like we have in Australia over the last 2 decades. Well, I got news for you, folks. You're in for a world of hurt. How much is property going to fall? I got no idea. I don't put targets like that on housing because we really don't know. But we're in for a world of hurt because I see the inside. I see, as an owner of a national mortgage broking business, I see the debt levels that people are in. I see the mortgage stress levels that people are in. I see the amount of disposable income going to mortgage repayments at record low interest rates. We've got an inflation problem. Interest rates are rising. So I see what that means for house prices. If someone's borrowing capacity goes from $1 million to $500,000, well, guess what's going to happen to the market? The market has to meet what people can buy. Now, I'm not saying that houses are going to crash 50% either. I just use that as an example. But, you know, as a property investor, I've still got a couple of investment properties myself. I had 6 investment properties as of the beginning of 2021. I had 6 investment properties. I've got 2 now. So while prices have gone up, I've used this crack up boom to sell. I've put my money where my mouth is. I'm not telling anyone to buy, to sell, to whatever. I don't give advice. All I do is give education and try to help you guys and share with you guys what I'm seeing as an Austrian economic analyst, as an investor, as a trader. I try to give you guys what I'm seeing and my opinion. And hopefully that can help you make some wise decisions. I don't give investment advice. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. Do you think we're going to see a housing market crash? Do you think we're going to see house prices continue to go up the way they have? Or do you think they'll go sideways for a little bit? Anyway, love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, guys, and I'll see you all again on another episode of Finance Uncut.